3 decades, America's most popular program about the economy, people, and their money, Wall Street Week with Louis Rukeyser, is made possible by the annual financial support from viewers like you. By Prudential Securities. With more than 5,600 financial advisors nationwide, Prudential Securities provides solutions for a lifetime of investment needs. That's the power of the rock at work for you. By the financial consultants of A.G. Edwards, who realize that investors like investments come in all shapes and sizes. A.G. Edwards, be comfortable. By Oppenheimer Funds, where a long-term approach to investing has helped put financial security in the hands of millions of Americans. Oppenheimer Funds, the right way to invest. And by the Kaufman Fund, a small company aggressive growth fund. Produced Friday, April 16th. Tonight's special guests are Jon Litt, Senior Real Estate and Lodging Analyst, PaineWebber; Mark Zandi, Chief Economist, RFA Dismal Sciences Incorporated; and Ivy Zelman, Housing Analyst, Credit Suisse, First Boston.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when we found out that there's another solar system far out in space, with a family of planets orbiting around a star not unlike our own sun. Now, the casual observer, who of course never would have spotted Upsilon Andromedae in the first place, might assume that while this is exciting news for astronomers, it actually has very little relevance to the lives of the rest of us, who until now never knew this new prospective tourist resort even existed a mere 44 light years away. How wrong that casual observer would be. For it turns out that the folks, if there be any, out there in Upsilon Andromedae, would appear to have an awful lot in common with what's been happening lately here on Earth. One of the 3 large planets that have been detected, for example, would appear to be populated by internet stocks. It's so close to its star that it is presumably unbelievably hot. It moves at such an incredible pace that it completes a full orbit each year, every 4.6 Earth days, and its proximity to all that heat could make it especially vulnerable to a meltdown. The other 2 planets spotted so far have several times the mass of Jupiter, the largest planet in our solar system, but are much closer to their star, which means they're rotating faster, and thereby, would you believe it, providing another timely stock tip for their Earthling cousins. For this was the week in which the rotation of common stocks accelerated dramatically. Just about everything that used to be hot, such as computer-related technology stocks, was tumbling out of favor, while just about everything that used to be cold, like energy stocks and commodity stocks and cyclical stocks and smaller stocks, was rushing brightly into the sun. See? If you wanted to know what was going to happen next, you shouldn't have been looking at the ticker. You should have been gazing into your telescope. And it was not just in the area of finance that striking similarities to our own situation could be glimpsed. While we don't have any evidence yet of life on those far-off planets, at least 3 remarkable clues can be discerned. The first is that the planets seem to be especially gaseous, which suggests the possible presence of many politicians. The second is that none of those planets seem to have a coherent foreign policy either. And the third is that there are enough remarkable similarities to our own system that if there are any little Upsilones out there, they probably think Dennis Rodman is pretty weird too. Next thing you know, they'll be going public. We tonight will be coming down to earth in every way, for the subject of this special program is real estate, and all the ways it might fit into your own financial life. We'll see whether it's still worth following the investment advice of Will Rogers, who said, buy land, they ain't making any more of it. But first, let's see what was putting the truly bizarre extraterrestrials of Wall Street into orbit in the week just past. To look at the Dow Jones Industrial Average, you'd think it was another great week. With its heavy weighting of cyclical stocks, those tied closely to the performance of the overall economy, the Dow was a beneficiary of the latest rotation, and the index set a record every day. The first week it has achieved that feat in more than a year. For the week, the Dow added 320 points to close just shy of 10,500, carrying its three-week gain to nearly 700 points. But after setting records on Monday themselves, the other big indexes faltered on record-heavy volume, with the tech-driven NASDAQ taking its worst beating in more than 2 months as the market broadened and shifted, giving the best rewards of all to the small stock Russell 2000. The new buying interest in the Dow's manufacturing and commodity-linked components was enough to shift Elf Bob Stovall from neutral to bullish on the averages next 3 months, since he expects the broadening momentum and focus shift to continue for that period, leading to a greater than 5% advance. With the consensus now at a bullish +4, Stovall is one of 5 elves who get our halos tonight for having been correctly bullish 3 months ago, since when the Dow has surged more than 12%. Among the week's conspicuous winners was the energy sector, as oil prices rose to a 1-year high amid expectations that producing nations will reduce output enough to eliminate the recent glut. That news, combined with continuing dollar weakness against the yen and some signs of a stronger U.S. economy, such as better than expected new home construction, sent long-term bond yields inching back above 5.5%. And in the least surprising poll result of this tax-paying week, 68% of registered voters who were asked to name their favorite candidate for an IRS audit replied without hesitation, "My congressman." Before we get to the land of real estate and vice versa, just a final reminder that next week will mark our 10th annual induction into the Wall Street Week with Louis Rukeyser Hall of Fame. So there's still time, if you have a favorite you'd like to nominate for the judges' consideration, to visit our website at pbs.org and tell us who you think should be the 20th member of that elite academy. And now, before we meet tonight's special guests, each of them experts on a different area of real estate, let's see if we can't get a better handle on what's really been happening in this key American industry from the ground up. Owning a home of one's own, with or without a white picket fence, has always been a major part of the American dream for citizens of any age. Interestingly, the median age of first-time home buyers was younger a decade ago than it is now. The age of the typical buyer of a starter home peaked at 34 in 1994, but was still above 32 last year. The number of dollars those buyers had to shell out for the average existing home in America has continued to accelerate. Below $100,000 when the decade began, the median price passed $130,000 in 1998. Those shelling out for a brand new home have typically had to pay more, but the percentage increases have been slower this past decade. By last year, nonetheless, the median price of a new home in America was above $150,000, a price that a couple of generations ago would have bought you a mansion. Though falling interest rates have spurred a boom in housing, it has been an uneven boom for investors in housing stocks. But a surge just this past week has focused attention on them once again. For comparison, since the start of 1997, the broad S&P 500 index has gained about 78%. A week ago, the S&P Home Building Index, which tracks Fleetwood Enterprises, Centex, Kaufman & Broad Home, and Pulte, had advanced barely more than half that amount, but it's now close behind. While the Building Materials Index, which includes Armstrong World Industries, Masco, and Owens Corning, though still a distinct laggard, has nearly tripled its total advance of a week ago. Worst of all in this area, you could have put your money in real estate investment trusts, whose index even now shows a net loss over the past couple of years. But lest you think no investor in real estate-related companies was actually making out like a bandit since the start of 1997, know that the Retail Building Supplies Index, comprised of Home Depot, Lowe's, and Sherwin-Williams, has been one of the market stars, advancing fully 232%. So as in picking a home, you clearly have to be selective to be an ultra-successful investor in real estate. With me tonight are 3 experts on real estate. Ivy Zelman, whom we knew by her maiden name of Ivy Schneider in her previous 3 appearances on the program, is the highly regarded housing analyst for Credit Suisse First Boston. Jon Litt of PaineWebber is one of the industry's top-rated analysts of real estate investment trusts, or REITs. And Mark Zandi is a leading independent economist and analyst of housing trends. Ivy, other than the fact that you were going to appear on this program, why have so many of the housing stocks suddenly come to light?
Well, it's certainly been a lot of fun the last few days, considering the stocks have been down for so long. But clearly, for the last 2 years, we've continued to see the robust fire pace of housing activity, and numbers have continued to go up. So when you look at the first quarter, all of them are likely to surprise, and they were so oversold that certainly I think investors have just had to take another look at them, and that could be one reason.
Well, interest rates have been down for a long time. Consumers have been in a good mood for a long time. Why has Wall Street not been more enthusiastic?
Well, it's tough to read Wall Street, but I think right now it's the anticipation of an eventual downturn, and after 8 years of economic expansion, it's sort of the lingering black cloud that everybody's waiting for, and it's been a highly volatile group in past decades, so therefore they're concerned, and maybe not legitimately concerned given that interest rates are still so low and job formation is still so strong.
What's your outlook for the next 12 months?
Well, certainly it looks very bright still. I mean, housing couldn't be stronger. Labor's short, so many people aren't getting houses built that want houses built. Numbers keep going up, and I think that the housing stocks will continue to rally. And yet, you know, if this first sign of an interest rate increase, they may quickly lose the rally. But in the short term, it's looking very good.
We'll come back and get some names from you, but first let me turn to Jonathan Litt, who has the difficult task of covering the most hated group in this area lately, the real estate investment trusts. Year after year, decade after decade, these stocks have their enthusiasts, but they've been a great disappointment lately. Why?
I think that's a great lead-in to a challenging group the past 18 months. As you look at the REIT industry in the 90s, there's been a dramatic change from prior cycles. It really began in 1991 when we saw a change in the legislation of real estate investment trusts, which allowed them to be internally managed and internally advised. So for the first time, we had an alignment of interest between shareholders and management. And we've seen an explosion in the REIT business, from a $15 billion industry to a $30 billion industry. We've had some of the best private companies in the U.S. now available in the public market. I think what we've experienced in the last 18 months is growing pains of an industry which has been blossoming the past 7 or 8 years.
One might think that the environment wasn't all that bad for REITs, because money market funds weren't paying much, utility stocks weren't paying the way they used to, and REITs were a source of higher income for many people. Why didn't they capture more people's attention?
I think what happened was that a couple of the REITs, and the enthusiasm for the success and the increasing size of the industry, probably did things that they shouldn't have done. And it was very high profile. And as their stocks started going down, I think it tainted the whole group, and it brought the group down as well.
What sort of things did they do they shouldn't have done?
They were too aggressive at buying. They probably overpaid for some real estate. They entered into financial instruments which were probably a little too esoteric for the underlying asset class. But I think the bottom line is, right now we're trading at tremendous discounts to both the stock market, the bond market, private real estate values, and I think that it's a very good time to be buying into REITs, particularly in light of what's happening to the valuations of most other asset classes.
Nowhere to go but up, in your judgment.
Well, we've had a great week. We're up at 9% this week, and I think there could be a little pullback, but I think we're going to continue to see the group doing well.
We'll come back to you for some specifics too, but let me turn to Mark. We talk about a vigorous housing market, and it is that, but the housing starts aren't back to where they were in the early 70s. Is that just a function of the changing population?
Absolutely, that's all it is. The baby boomers were entering into their prime buying years back in the 70s. There were lots of us, boomers that is. In fact, if you go back into the 60s and 70s, we were forming 1.7 million households per year. That supports a lot of housing construction. And of course now, the boomers are well past that time. We have the baby bust generation in their prime buying years. Their demographics just aren't there, so we can't support now the kinds of housing starts and activity that we saw back in the 70s and 60s.
Do you expect the current boom to continue?
No, I expect housing market conditions to remain good. 1999 will be a good year. It just won't stack up to 1998. That will be, in my judgment, the high water mark for the housing market for perhaps a generation. The demographics just don't support the kinds of home building, the kinds of housing activity that we saw last year, and it will be weaker going forward.
You mean too many of us are living and getting older?
That's exactly right. Absolutely
It's
true.
a horrible thing. We should probably do something about that immediately. What do you make of the outlook for the next 12 months?
Well, I think for housing, it'll be fine. We'll have another year of good, strong housing starts because mortgage rates are low, the economy is strong, generating lots of jobs. As long as the stock market hangs in there, confidence is going to remain at record levels. Mortgage lenders are very aggressive in extending credit. The subprime mortgage market has just blossomed in the last several years. And the Clinton administration has been very proactive in promoting home ownership and very successfully through affordable loan programs. And so we've seen a broadening in the market for home buyers. And so 1999 will be another good year. It just won't be as good as last year.
Do you find the interest uniform across the country, or are some areas much more attractive than others?
This is the hallmark of this housing market. It's coast to coast. You pick the market, it's doing fine. From Boston to the Bay Area of California, things are going very well. Home sales are strong, housing starts are strong, house prices are growing very, very rapidly. It's only a pocket full of areas, and you can count them on your hand, that are not doing well.
How important to your forecast is the continuance of relatively low interest rates?
Well, that's obviously key. Low rates have been driving the market. Mortgage rates are near a 30-year low, and as long as they remain this low, that keeps affordability high and will keep people buying a lot of homes. So that is very important.
We'll let you lead off in the highly credible game of interest rate forecasting. What do you expect for the rest of this year?
Thank you so much for that. My view is that interest rates will remain relatively stable through the year, that there's this juxtaposition between a strong domestic economy and a relatively weak global economy, and that'll be enough to keep interest rates relatively low and stable.
Good time to sell a house? Is it a good time to buy one?
Both. It's a good time. If you have any interest in housing, this is the time to do it. Get out there and buy and sell and be active.
Ivy, do you agree with that interest rate forecast?
I was hoping you weren't going to ask me that question. I was excited when you asked him. Today, with inflation pretty much non-existent, I wouldn't expect rates to go up anytime soon, but certainly would like to see them in a very narrow trading range.
Is there a magic number for mortgages below which sales are good, above which sales are bad?
You know, a 7% mortgage rate is certainly, I think, a stimulant number, and looking at today's environment, we should still see incremental demand at these levels. Anything above, I think, 7%, approaching 8% might start to, cut things off a little bit.
What are your favorite areas for investment now?
Well, given the baby boomers and the aging population, I think right now 2 areas I like: building products as well as home furnishings, because I think that's where the wealth effect will have the greatest impact. And I have some favorites there.
Perhaps you'd disclose them.
Sure, love to do that. First, and probably just because I have so many stocks, of 30 stocks roughly, the 2 that I would recommend as my #1 picks would be Ethan Allen, and there's a Canadian company, Royal Group Technologies, that makes vinyl-related products. Also like Black & Decker and Masco, they're repair and remodel related, as well as in the site-built in the home area. I'd look at Centex as a large cap name, and the manufactured housing, which has been an improved product area and affordability driving sales there, Champion Enterprises. So we've got, I'd say quite a few buys.
Is there a common thread that makes them your favorites?
Actually, yes. I like companies that have strong managements, have the ability to sustain earnings growth, have a niche in their marketplace, possibly a strong operating model with strong balance sheets. Really, I'm looking for companies that I think can continue to sustain earnings growth, even if we see some, or will, in fact, have a modest slowdown.
Though you all seem optimistic, Mark has indicated that he thinks last year was the peak for home sales in this cycle. Do you go along with that?
I do. I think that the demographics don't look as bright as they have been, and therefore the level of activity is probably not going to be sustained, but it should remain very healthy, obviously contingent on where mortgage rates will be and where the job formation numbers will go.
John, since you have the task of defending the REITs and you come with courage and a smile, tell us where you think the action is going to be.
I think the stocks you want to focus on in this environment are the blue chip names. I think when new money comes into the group, it's going to focus on the names with the largest market cap, the names which have the highest quality management teams, and the names which have consistent track record of delivering on results. I also think that we're in a new environment in real estate in the U.S. today where we have giant real estate companies, and there's new revenue sources that they can generate by being large. And the top names I would see in the group today are Simon Property Group, which is the largest owner of regional malls in the U.S., equity office property, the largest owner of office properties in the U.S., and equity residential, the largest owner of apartment units in the United States.
What sort of yields would you get with those stocks?
They range between 5.5% and 7% on average, and we've seen that the yields in the REIT industry, and on these stocks in particular, are going up about 5% a year.
The REITs, by their nature, by their requirement, pay out 90% of their income each year or more.
Right.
Does that keep them from growing as they might?
You know, the REITs are growing with no external growth about 7 to 9% per year. And when you combine that with a 7% rough yield, you're looking for a mid-teens total return. And I think that the restriction of having to pay out the dividend is not material on their ability to continue to generate that type of growth.
Maybe they just misspend it the way you said some of them did last year. Let's get you in the interest rate game. Do you disagree with what you've heard so far? You
know, it's incredible. I am not an interest rate monitor or expert, but we do watch it. And last fall, interest rates were going down. The beginning of this year, interest rates were going down. Now we start hearing people saying that the world economy is starting to get better, and maybe the next thing is a rate hike instead of a rate cut. And I leave it to the experts to really make that call. I think the real estate business is going to be fine as long as we're within a band where we are today.
Mark, what are the toughest sells in real estate these days?
Well, I think if you're someone who is in the home building industry that is going to cater to entry-level housing, perhaps to low mid-income households in the Midwest or Northeast urban areas, I think you're going to have a difficult time because the demographics are starting to work against you. The people that are going to be buying entry-level homes are going to shrink in size, and low-income households are still going to be under some pressure in this economy. It's a great economy, and everyone's doing well now, but when things start doing a little less well, it's the low-income households that will have trouble, and they'll just not be able to buy homes the way they have been over the past several years.
The status of this industry is very important when you want to buy or sell a house. It's very important if you're a contractor, if you're a housing supply person. How important is it to the overall U.S. economy? It's
amazingly important. We always underestimate its importance. I mean, if you just look at the sheer dollar spent on housing, it looks small. It's about 5% of our economy. But you think about all the other industries that supply the housing industry, that's another 5% of the economy, so already you're up to 10% of the economy. Then you think about all the other ways housing affects us in terms of the wealth effect. I mean, when house prices are rising, we feel wealthier, we go out and spend more, we're more confident, and that has an impact on the economy. And if you add all these things up, housing, in my judgment, accounts for perhaps 20–25% of the growth, particularly in a year like 1998 when housing was doing so well.
Ivy, what do you hate? Where wouldn't you put money these days?
It's hard to hate stocks that are so oversold. I think that this group at this point is, I guess, had the worst performance if you looked at the broad market, and today it'd be tough to sell them at these levels. I may not be pushing hard for you to buy them given the late stage of the cycle on a long-term basis, but certainly, and when we say long-term, we always think about 12 months, but for individuals with strong stomachs that are willing to ride out, there could be a 3 to 5 year horizon that they might want to buy some of these really cheap builders. But to sell here, I think with this environment, doesn't make a lot of sense.
John, you've told us which REITs you'd buy. Which ones wouldn't you buy?
You know, I'd sort of echo Ivy's comment, and that is, with the grouping under as much pressure it's been under, it's probably not the time to be selling them. I think there's a handful of names where management is taking some missteps, or we're seeing some overbuilding, and they'll probably stay under pressure. But as we've seen the past week, when the group moves, it's spontaneous combustion, and it just goes. We're up, 8% now. We're 20% below the peak. I think it's going to continue to move, and I wouldn't be betting against them in this environment.
Quick last question. You said you liked mall construction. Does the internet threaten that?
There's a lot of concern about the internet, and that's been impacting the stocks. I think that the malls are really entertainment-oriented, they're more social-oriented, more fashion-oriented, and I don't think those are things you could do on the internet.
Sounds like a fellow who knows some teenagers. Thanks very much, Ivy Zelman, Jon Litt, Mark Zandi, for joining me tonight. Hope you'll be back with us again next week. I guess then will be a real Wall Street rarity, a quiet tycoon. He's Richard Schmaltz, who runs more than $31 billion for J&W Seligman & Company, but has only recently emerged from the shadows of such successful big money management. And he'll be opening up on how he did it just for us. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser is produced in association with Rukeyser Television Incorporated by Maryland Public Television, made possible by the annual financial support from viewers like you, by Prudential Securities. With more than 5,600 financial advisors nationwide, Prudential Securities provides solutions for a lifetime of investment needs. That's the power of the rock at work for you. By the financial consultants of A.G. Edwards, who realize that investors like investments come in all shapes and sizes. A.G. Edwards, be comfortable. By Oppenheimer Funds. Every year, millions of Americans place their financial futures in the hands of one mutual fund company, Oppenheimer Funds, the right way to invest. And by the Kaufman Fund, a small company aggressive growth fund. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Maryland Public Television, Owings Mills, Maryland, 21117. Transcripts are also available to subscribers of Dow Jones Interactive.